Very good afternoon to each one of you. I'm very happy to be here. In fact, I'm just on time. I realized that good thing I came in earlier because my slot is supposed to be 4:05, but it's great. We have a bit more time to discuss about this very important topic. How is everybody today? Are we okay? Yes. Okay, great. Now, firstly, I'm really quite surprised to see so many of us. I thought, this is the last session. I come, the auditorium will be 50% empty or 50% full, but it's very encouraging to see so many of you here. I've done this auditorium before. It is really, really steep, so I can't see any one of you at the back. Okay, I can only see it like that. Okay, so it'll be helpful. Okay, later on as we go through our presentation, you can give me some acknowledgement. If I ask you some question, if you're okay with it, you say yes from behind, because I really can't see anyone from behind. Just to check, how many of us have the privilege to speak to? How many? If you have heard me before, hands up just to... Okay, thank you very much. Okay, so most of us have not heard me speak before, so this is pretty new material for all of us. But for those of us who have heard me, some of the things you may hear before, I'm very thankful that you are here. But I hope it's a good refresher for all of us. Now, this is what I'm going to do. I'm going to take us through about 40-45 minutes of this material. And after that, we'll transit into the closing remark for today's session. I do hope that you do stay until the closing remark, because some of the things that I really want to share from my heart, I'd like to share with all of you in the last 15 minutes. All right? So, shall we start? Yep. Okay, great. Let's start. Okay, so the topic given to me today is investment strategy, or investing before and during retirement. Because there is really a difference between investing towards retirement and investing during retirement. Most of the time when we hear about investing, whether we hear from speakers, we read from books, usually it is about investing towards retirement. Actually, that's the easier part. The investing during retirement part is the harder part. Okay, it's more complex, and later on you will see why it is more complex. Right? But I just want to be clear that there are two parts, and the way we go and the way we approach it is really quite different. So let's get into it. So assuming that this is your timeline, this is your life, okay, and this is where you start now, regardless of your age. Most of us at about 55, 60, 65 years old, for most of us here, this is the time of our life whereby we want to slow down, retire, or some people call it financial independence, whatever you call it. Usually it happens around 50, 55, 60, 65 years old, thereabout. Now, when we retire, and I've spoken about this before, sometimes we don't really know what to plan towards. So, if I may reduce it to the irreducible minimum, what you should be really planning towards, at retirement, there are three things that you really must have. The first thing that you must have is you must have a fully paid house at retirement, because if we don't have a fully paid house, we really cannot retire. That's the first objective that you should strive towards. Now, the second thing that you must have is that you must have a good medical expense insurance, so that if we are sick during retirement, we have an insurance plan that will pay for our medical expenses. And I know today, all of us, we will have MediShield Life. If you're a Singaporean PR, you should have MediShield Life because it's universal cover. But MediShield Life only allows us, or rather it is planned for us to stay in a B2 and C ward. If you want a slightly higher ward, if you believe that going for a private ward or an A ward or that gives you more privacy and you want that privacy, then you can't depend on MediShield Life. You have to upgrade. Okay? We're not here to talk about that, so I shan't spend too much time on it. But it is important that we have a good medical expense insurance. And of course, the third thing that we must have is that we must have money. Because, as I always say, no money, no talk. In retirement, we have no money. There is no retirement to talk about, really, because retirement needs money. So if I can simplify it to the irreducible minimum, at retirement, these are the three things that you must have. And we are all, for those of us who are still young or younger, and we are planning towards that, that's the three things that we must at least have in retirement. So, when you are younger, you are really at the accumulation stage. You are accumulating towards at least these three things. But once you pass that age, and once you are into retirement, you are really in a decumulation, or what I prefer to say, in a withdrawal stage. Now, so this part of our life is accumulation. This part of our life is really about withdrawal. So let's start by talking about accumulation. And to me, the simpler one, right? Now, in accumulation, we are really investing towards a certain objective. And there are really a few instruments you can use. First and foremost, we have our CPF special account. Now, I know many of us will look at this like a financial instrument. But if you change your paradigm, it is really an instrument. Because it is an instrument, I know it's an account, but it is an instrument that at this point in time still guarantees you 4% every year, risk-free. Okay? The only risk that you have in putting money in this account is what? What crash? The Singapore government crash. And what is the likelihood? Is it possible that the Singapore government crash? Yes or no? Well, you're very confident. It all depends on the result of today's Bukit Batu night. Okay, no, I'm just kidding. One constituency will make that much difference. Okay, but of course, I mean, if we are practical, if we are pragmatic and realistic about it, it is possible that the Singapore government go down. It's possible, right? Nothing is impossible. But at least at this time, well, in the foreseeable future, it's unlikely. I won't say it's impossible, but it's unlikely. But it is that safe. 4% guaranteed, and I know many of us here will know that a certain portion of your money, you get an extra 1%, right? So you have a portion of money guaranteed 5%, risk-free. Now, if you've been managing or investing money over the last 10 years, and if you are honest about it, to get 5% annually, it's not easy, isn't it? Especially post-08, it's not easy. This is 5% annualized, guaranteed, no volatility. This investment is a straight line investment. Okay? There is only one problem to this investment, and that is, it is like joining secret society. Very easy to join, impossible to get out until 65 years old. Right? Yeah, but if you can accept that, no liquidity, it is fine. I mean, if you are in your 40s, and if you want to buy an insurance endowment, you might as well buy this, right? Because you're prepared to lock up for the next 20 years anyway, right? So think about this as an instrument, but I have one caveat. This 4% guarantee is a yearly renewable thing. Since January of 2008, the government has already said that there is no more permanent guarantee to this special and retirement and your MediSave account. The return of your special MediSave and retirement account is pegged to the 10-year Singapore government bond plus 1%. That is the formula now. It is just that since 2008, they have been guaranteeing it year after year after year. So every year in December, you read the papers. They will tell you whether it is still guaranteed next year or not. Yeah, but as it is right now, it is still pretty good. In fact, very good at 4 to 5% risk-free. So this is one instrument you can consider using. If you have $1, consider taking some of your money and top up your special account. Okay? And you don't have to pay any commissions for it. Isn't it nice? Low cost. Now the second instrument you can use, of course, is endowment plans. Of course, after you top up, because for the CPF special account, there is a maximum you can top up. Yeah, and once you go beyond that, you can't top up anymore. And if you have some more cash and you want to start saving towards it, well, of course you can buy an insurance endowment. However, endowment returns increasingly are not getting interesting. Okay? If you can get about 3% after 2 years, you give yourself a pat on the back and say, well, not bad. Because it is not easy. And I'll talk a little bit about that in my closing remarks. Something that I need to warn you about. But please just know that for endowment, at best you can get maybe 3% after 20 years. But yes, it's an instrument you can consider. Now, beyond that, you really have to invest if you want to get higher returns than something that is 3 and 4%. And because you need to invest your money, you need to take some risks. And many of us here, you have heard me say this before. In order to be able to invest and get some returns, you must invest in something that you are able to stay invested for a long period of time. You know, I've been managing money, I've been in this business for about 20 years. I've been managing clients' money for maybe about a good 15 years. And I've made many, many mistakes before. My clients have lost money before, especially in 2008. And in all these years of managing money, there's one lesson that I learned. If I try to guess the market, you get in, you get out, most of the time, we are wrong, even for professionals. And I've given many, many interviews on media before. They always ask, where is the market going? Okay? And most of the time, after I say it and I check, most of the time, I'm wrong. So what's the moral of the story? The next time you see me, don't listen. Or just by opposite, you probably get it right. But that's the biggest lesson I've learned. And over the last 5-6 years or so, post 08, I have realized that when I do lesser changes, in, out, I get much, much better return. Yeah, so if you want to invest, for most of us, I would say that you should really stay invested for a longer period of time. But in order to be able to do that, you need to have the risk appetite to stay invested. How do you know your risk appetite? It is not as simple as doing just a risk profile question. Like, when you come to the financial institution, you want to buy a product, we give you some questionnaire, 5 to 7 questions. Well, that's necessary, but that's not good enough. To really understand your risk profile, the first thing you must know is whether you need to take risks. How do you know your need to take risks? It really depends on your need for returns. The higher your need for return, the higher your need to take risks. Makes sense, right? Now, what is a high return? Okay, I will say that in today's environment, okay, and my numbers have changed, I'll tell you, since 10 years ago, because returns have dropped tremendously, and you will continue to drop over the next 20 or 30 years. So for today's climate, I would say that if you are aiming for 7 to 8% annual, every year 7 to 8%, that is pretty risky. Your need to take risk goes high. If you are aiming for 4 to 5%, that is like your medium risk, or 4 to 6% maybe, that's your medium risk. Okay? If you are going for like 3%, 2%, that is low risk. So depending on your rate of return, your need to take risk goes up. That's the first thing you've got to ask yourself when you're investing towards retirement. What is my need for return? Secondly, you need to be able to understand your ability to take risks. Okay? And I'll talk about that in a short while. I'll give you a more elaborated explanation of what ability to take risks is all about. And thirdly, it is your willingness to take risks. And these three, you have to reconcile. So, let me now elaborate a little bit. Now, need to take risks, as I've said, is based on your need for return. Okay, we have settled that. Your ability to take risks is determined by many things, and some of these things are, firstly, your age. The younger you are, your ability to take risks is higher. The more time you have, your ability to take risks is higher. Financially, if you're healthy, you've got a stable job, your income is pretty decent, you don't have a lot of debt, your debt servicing ratio, your debt to asset ratio is healthy, well, you have a higher ability to take risks. If physically you are healthy, of course, you have a higher ability to take risks. If your insurance is well done, you're well covered, you have a good ability to take risks. If you are single, your ability to take risks is naturally higher because you have less responsibility, less accountability. If you are married, your ability to take risks drop. If you have children, 2 kids, 3 kids, your ability to take risks drop further. If you have 10 kids, you might not have any ability to take risks. Yeah, but you understand what I'm saying. Yeah, liquidity. If you are investing for a very short term, 1 year, 2 years, then your ability to take risks is lower because you need to know the best time to get in and get out. And if you get out at the wrong time, you are really done for. But if you don't have liquidity needs, these are your spare cash, then your ability to take risks is higher. Now, you're investing a small amount relative to your overall cash, your ability to take risks is higher. If you're investing everything, then you can't take too much risk, right? Because if you lose it, you lose it. So some of these things affect your ability to take risks. And when you are making some investment decision, go through this list and ask yourself, do I have this ability to take risks? And last, and definitely not least, is your willingness to take risks. And that I mentioned, well, you can do that, well, through a questionnaire. But honestly, even if you don't do any questionnaire, you know whether you're willing to take risks or not, isn't it? The questionnaire, you do it is because financial institutions like mine need you to do it. So that if things go wrong, I can blame you. It's not my fault, but you can take risks, right? Yeah. But really, okay, I'm joking, you know that. But really, even if you don't do that questionnaire, you know whether you are willing to take risks or not. And once you know these three things, like I say, you need to reconcile it. What do I mean? You may have a high need to take risks. Say you calculated that you need 7-8% risk. You may have a high ability, or let me say that again. You calculate and you realize that you need 7 to 8% return. And therefore, you need to take pretty high risk. And you calculated, you go through all these things and you say that, yeah, I've got a pretty high ability to take risk. You have high need, you have high ability, but you might not be willing to take risk. You have the need, you have the need, you can take the risk, but you're unwilling. Then how do we reconcile that? If you really don't want to take risks, then your expectation of return has to be adjusted much lower. Then your expectation for the kind of lifestyle that you want has to be, you have to adjust it much lower. If you're unwilling to adjust it lower, then you would have no choice but to take the risk, even if you are unwilling. Let's say you don't need to take risks. Say you are in retirement and you don't really need to. Now, I'm not saying that all retirees don't need to take risks, don't get me wrong. I'm just saying that you decide that you don't need to take risks. All you need is 3% return and you are okay. So you don't need. And you cannot take risks anyway. For all the reasons stated there, let's say you are not able to take risks, but you are very willing. You don't need, you cannot, but you want. I mean, yes, we laugh, but there are people like that, right? Don't need, cannot, but want. My mother used to tell me in Hokkien, that's called Ti Ki. Then what do? If you really don't need and you cannot, my suggestion is even if you want, you shouldn't. Because there is no need to, and you can't. Why should you? So that's why you need to reconcile these three. Okay, once you are reconciled, then you know what kind of risk you can take. And once you know the kind of risk you can take, the next step really is to design your portfolio. Now, I have no time to talk about designing of portfolios, okay, because this subject takes a bit of time. But suffice it to say that, okay, now let's say you are a low risk taker. For those of you who are copying this, taking down picture, this one is example. Sample, can you see sample? Okay, please don't go back and follow to the dot. Okay, it's an example, okay? Yeah, and I'll tell you this same slide, I've used it for many times over many years. They have changed today. Okay, so this is an example of how it will look like. Alright, so if you're a conservative person, that means to say, for example, you have no need to take risks, you cannot, and you are very unwilling to take risks, and you're pretty happy with a 2%, 3% kind of return, or 3.5% kind of return, then, okay, I don't know whether you can see my laser, okay, it's a bit, not very clear, right? But you see this one, can you all see? Yeah, okay, conservative, you will see that you will put more money into cash, 30% Singapore cash, okay, and then more in bonds. Okay, more in bonds, okay, and lesser money into the riskier instruments such as commodities, equities, emerging markets and all that. These are risky, only about 15% is there. Okay, so that the volatility of this particular portfolio, the ups and downs of this portfolio is something that you can take. Yeah, that you can take, and you're able to sit through the ride. Because once your investment starts, you know it is not like your CPF money straight line. It is a Battlestar Galactica. It goes up, it goes down, it goes up, it goes down. And as I've said, the way to get the return is you must be able to sit through the ride. If halfway through the ride, your heart can't take it, you press the button and you jump out, you are dead. So the whole idea of knowing about your risk appetite is so that you find a roller coaster, an investment roller coaster that you can sit throughout. And so if you have no need, you cannot, and you are unwilling to take risk, then your roller coaster will look like this. Just smile, it goes up and down, it goes up and down, but you are fine with it. Now, let's say you have got a high need to take risk and you are able to and you are very willing. Then maybe this roller coaster is suitable for you. Okay? The aggressive one. And you realize that you have just more money into stocks. About 85% is into stocks and commodities, with only about 15% here into very safe assets such as cash and bonds. But you expect this to be really Battlestar Galactica. Okay? And you must have the appetite to do so. Now, having been in this industry for a while again, I always notice this. Usually before the investment, a lot of us can say, can one. Then when the ride start, then we start vomiting, then we realize, oh, cannot. Okay? So you really have to understand what the volatility looks like. And if you are using an advisor, my suggestion to you is ask the advisor, how does the volatility look like? Okay? And we will have to tell you in terms of percentages, plus minus 15, plus minus 20, meaning to say that if the average return of this portfolio averages, say, 5%, that's the expected return. If it's a plus minus 20 volatility, you expect in a good time, it could be as high as 25%. In a bad time, it's minus 15%. It goes in a wide swing. And this only happens like 2/3 of the time. There could be possibility that the swing is even higher. That's how we explain risk. And you've got to mentally imagine whether can I take this kind of volatility or not? And if you tell yourself, well, cannot man, minus 15, I will vomit, then this is not for you. Right? The whole idea is to be able to sit through. Because this word risk is English. And English is very subjective, right? Because I say high risk to you, nothing, why are you so scared? If I say low risk, to you maybe very high risk. It's a very subjective word. So you really need to find out tangibly, what does it mean in numbers when it is fluctuating? Are we okay so far? Yeah? Are we okay? Yeah. Okay, good. So now, once that is done, you can start investing, and like I say, and the whole idea is that you should stay invested. Now, I have no time to talk about the instrument, but suffice it to say this. For most of us, I wouldn't suggest you that you put your serious money into stocks, individual stocks. I wouldn't suggest. Your serious money. Okay? I wouldn't suggest. Now, if you want to use unit trust, you can, but unit trust is very expensive. Okay? I would suggest if you really want to invest and you want to be more broadly diversified, I would strongly suggest that you use exchange traded funds, ETFs. Okay? Very low cost, very, very low cost, okay? And very broadly diversified. Okay? It's easily available in the SGX stock market. You can call your broker, you can call certain financial advisors, they also help you transact. So I would suggest you use ETF rather than you buy individual stocks. Now, after you have invested your serious money and you still got spare cash left, by the look of all of you in this room, I can tell you got plenty of spare cash. But then you want to go and pick one stock, you want to go and buy one bonds, and all that. Well, then okay, go ahead and do it. Yeah, but your serious money, try not to be narrowly focused into just one stock. And nowadays there are a lot of retail bonds, the last being perennial. Those of you who buy bonds will know perennial bonds, all that. Okay, I don't want to say too much about all this instrument, but I'll suffice it to say that it's too dangerous if you want to put your serious money into just 1-2 stocks or bonds. I'd rather you broadly diversify. And this is not just what I say. Even Warren Buffett himself said that. Yeah, the king of investment says, for most of us, just go and buy an index. It's actually good. Okay, so that much for accumulation. Because I don't have much time, let me just check my time a bit. Okay, 4:20, good. Okay, so that is the accumulation part. And that is really the easy part. It's easy, isn't it? It's quite straightforward. Yeah, you just invest, you stay invested. I mean, it's easy in the head, but when it starts, the heart not so easy. Yeah, but at least we understand. It's not complex, not complicated. Now, let's go to the withdrawal. Okay, now even for those of us who are younger and you are still in the accumulation phase, it is good for you to understand withdrawal, because when you understand how ultimately you want to withdraw your nest egg, the way you invest will be quite different. So let me talk about withdrawal. Now, in withdrawal is all about, now you have accumulated a pot of money and you want to take a monthly income out from it. Those of you who have stayed in the morning, I'm sure you have heard of dividend. I mean, you have heard the earlier speaker talk about investing using stocks, bonds, REITs, and all to get income. That is one way. Yeah? But I'm going to give you another perspective. Now, in withdrawal, your income should be split into two parts. The first part is basic income. This is the income in retirement that you die must have. You need this to pay utility bills. You need this for a basic retirement. Determine what this basic income is. So you might decide, you do some calculation, you realize that, actually, if I've got $2,000, I'm okay. Basic. Okay? But of course, if I've got 4, that would be nice. So your retirement income maybe is 4,000 per month, let's say. Out of which of this 4,000, 2,000 is the die must have. The other 2,000, if you have 2, great. If you have 1, then okay, not so good, but I'm fine with it. You clear with this concept? Yeah? So you have to determine this basic. Now, for the basic income part, how do you invest to get this basic income? The die must have. My suggestion is that, okay, for your basic income, use your CPF Life. Okay? You might like CPF Life, you might not like CPF Life. I mean, I don't have time to talk about, CPF Life in detail, but I understand. Some of us, we hate CPF Life, or we hate CPF Life. Anything CPF we don't like. But some of us, we love it. Okay? But whether you like it or you don't like it, it is here to stay. You might as well make use of it. CPF Life, in simple terms, is actually an insurance annuity. Actually, that's it, Yeah? Look at CPF account as an account that you save every month. And then at the end of your retirement, or at the beginning of your retirement rather, at about 65 years old, it gets converted into a life annuity. And it pays out monthly. So your die must have, you can make use of your CPF Life because it's very safe. And if your CPF Life payout is not enough, and you got a bit more cash, you can consider buying a private annuity. The returns guaranteed is not as good as CPF Life. Okay? But, well, if you need more than what CPF Life can provide for you, buy a private annuity. Now, and of course, if you've got some more cash and you need some more basic income, then you can invest in retail bonds. Okay? Retail bonds. And for those of us here whom you are accredited investor, meaning to say that you have 2 million net worth or your preceding income is about 300,000, last year income, you are called accredited investor. Then you can go into more of these bonds. They are only open to accredited investors. But to all of us out here who are retail investors, we only have a limited number of bonds that we can invest in. I've only got one thing to say. If you are a retail investor buying into retail bonds, spend a bit more time understanding the bonds. Usually, and I say this with a bit of care, usually the retail bonds are not as good as the accredited the institutional tranche. So you have to spend a bit more time looking at it. This period, a lot of bonds are launching. Okay? Be careful, especially those that are high yield, not investment grade bonds. The world, if you don't realize it already, we are overly in debt. You know what that means? Someday, something will happen. I mean, we are at a stage of our economy, and I don't mean Singapore, I mean globally, whereby a lot of debt is happening. A lot of debt is happening. Yeah, so be careful when you are buying bonds. It doesn't mean bonds is very safe. Yeah, there are bonds that are not rated or not investment grade. Okay, so just be very careful when you are buying retail bond. And I speak especially to retiree, because you have no more income. You don't want to put in a bond, it blows up, and then that's the end of your retirement. Right? But that's a consideration. You can buy a good bond, it pays a income, and it gives you that basic income. Okay? For your additional income, you really have to now invest it for a higher yield. Okay? Because all this, not very high. Okay? Highest is CPF Life, you get about 4. The rest, all below 4. Okay? Especially the good investment grade bonds today, maybe you get 2-3%, that's about it. Okay so far? Okay, good. Then let's talk about this additional income bit. How do we do it now? I'm going to use an example to explain it. I think it's easier to do it that way. This is not academic talk. We're not all studying for CFA exam or whatever. So I want to give you a case study to help you understand. Now this particular case study, okay, the background is this. Okay, it's a real case actually. Yeah, this is a client. he has accumulated about $500,000, 500,000, of which 150,000 is CPF money, 350,000 is cash, husband and wife. Okay? Now, honestly, in Singapore, to have $500,000 cash and CPF is not considered a lot. It's not going to give you a palace-like Forbidden City kind of lifestyle. I mean, this is Singapore. Yeah, you go elsewhere, maybe yes, but in Singapore, we all know the standard of living is a lot higher. Honestly, $500,000 today is not going to give us a very affluent retirement. Okay, quite normal for a couple. Work very hard, they've been saving, taking care of their CPF. So they have 150,000 in CPF, 350,000 in cash. Okay, now, and this couple, especially the gentleman, he said that he doesn't mind working for another 10 years, from 55 to 65, but he wants to begin to slow down. Okay, and finally fully retired, stop work. Okay, when he says retire doesn't mean he doesn't do anything, but he doesn't want to worry about money at age 65. So at 55 he slows down, age 65 completely stop work. Okay, and he said that every month he would like to have about $2,000 for him and the wife. He's happy with it. Okay, and once a while, if he can take out some money for maybe occasional travel, or give a gift, and all that to grandchildren, they will be happy. Yeah? And if can still leave something behind, okay, never mind. That's them. All right. Now, so based on the requirement, based on $500,000, one way. This is not the only way. One way to structure it is very simple. Oh yeah, one more thing about this couple. They don't really like investing, especially in retirement. They don't like the risk. So they say, I don't really like investing, but I don't mind just investing a bit. So you will realize that we only put 10% into the investment portfolio. Okay, and this investment portfolio gives about 5%. That's about it. Okay, so 10%, which is 50,000, okay, into the investment portfolio. The 150,000 retained in CPF, we didn't touch it, kept it there, put into CPF Life. Okay, and then the remaining 300,000, basically we bought two annuities. The first annuity is an immediate annuity. An immediate annuity means the minute you buy, it pays out. That's immediate. Okay, the other one is a deferred one. Okay, it pays out 5 years later. All right. Now, based on this simple combination, this is really simple, nothing complex. Now, what this person gets is this. Okay. Now, in the first year at 55 years old, because he bought that immediate annuity, he gets about $500 per month. No big deal. Yeah, but he can start to slow down and relax. He's getting old, so he wants to slow down. So he had $500 a month. 5 years later, the second annuity pays out, and so he has now about $1,000 every month. So he slows down some more. And then when he reaches the age of 65 years old, what pays out? CPF Life pays out. Okay, and together with the other two annuity, he has about $2,004. About $400 to $500, $400 more than what he wanted. And you realize we haven't touched the 10% investment yet. Nothing is on the investment. All this payout all came from very safe instruments such as CPF Life, annuities, immediate and deferred annuities. Okay, and it will pay out for as long as he lives. Okay, now how about that 10% investment into 10% of his money into investment? Now, if the investment market does well and his portfolio does well, he's free to take out some money and go for holiday. Yeah. If the markets are bad, okay, maybe that year no holiday, because for him, he says it's an option. Yeah, and well, he can take out some money from there and give gifts to grandchildren, so on and so forth. So the investment really are for things that are his additional income. It's not the die must have one. The die must have all comes from here. Are we okay so far? So what's my point? My point is, as a retiree in withdrawals, once you have determined the basic income that you need, okay, use very safe instrument to fund it. Okay? If you are investing, it must be really for things that, well, if it does well for you, great, you can spend more. If the markets are bad, then it's okay not to have it. Right? That's the concept behind. You cannot invest your money and expect it to fund even your basic income. Okay? Now, this is a really simple example. Now, I'm going to show you something that is very complex. Okay? And this is for people with more money, like all of us here. Okay? Now, don't mind the amount I'm going to show you. Okay? It's just to help you understand that the more money you have, the more complicated your life is. It's like that, right? Life is like that. Yeah? So I'm going to show you something that is very complicated. Okay? Please don't look at the thing and say, yeah, but I won't have 2 million, I won't have 1 million, you know, how you know, right? Maybe suddenly something dropped from the sky, you have, right? Yeah? But it's just to show you the complexity in retirement withdrawal. It is not so simple to say when you are younger, you can invest in equities, when you are older, you shouldn't. It's not as simple as that. So get ready. Now, let's look at David, okay, as the case study. Okay, this is also a real case study. Okay, now, for David, this is what he wanted. He says that when he retires, which is now, he wants to enjoy 10,000 per month for the first 5 years because he's still healthy. So you want to spend a bit more. And then reducing it to $8,000 for the next 10 years. And then finally, 6,000 per month till age 83. Okay? Now, inflation adjustment is 3%. This money must be inflation adjusted 3%. This money must last him for at least the next 25 years. At the end of 25 years, by then he is 83 years old. If he dies then, okay, he wants to leave behind $1 million for his loved ones. That's David. Okay, I know some of us looking at this, how can it be, you know? I say just follow, okay, because there are people who are like that, right? Now, but let's look at what he has. He has got money. 900,000 cash, 3,000 in shares, 400,000 in managed investments like ETFs, unit trusts, and so on and so forth. He has got CPF Life paying 1,000 per month. He has got an investment property that gives him about 2,000 per month. We adjust for 2% growth. And then he bought 2 endowments that were mature 2016, 2020, 100,000 each. That's the maturity value, okay, when it matures. So one will mature this year. This case, I did it a few years ago, so pardon the date, right? So that's David. Now, one final information we need. His risk profile. Now, earlier I talked about those people who are accumulating towards retirement. Now, to know what is the risk profile for somebody who is younger saving for retirement, it is about knowing your need, ability, and willingness to take risks. I've mentioned that. Or for a retiree, it's different. Okay? For a retiree, how do you measure a risk profile? The way to measure a retiree risk profile is by this thing called your safe retirement income floor. What is this safe retirement income floor? It is the die must have income portion that you need. Let me give you an example. So if I want $10,000 per month for my retirement, and if I die must have 8,000, I'm very conservative. Does it make sense? Yeah? If I want $10,000 in my retirement, and the die must have portion is only 1,000, the 9,000, okay lah, if I have, good lah, don't have, never mind. Then actually I'm prepared to take more risk for the fluctuation. Does it make sense? Yeah? So that's how we measure retiree risk profile. And for David, it is about 40 to 50% in between, and that is moderate risk profile. Are we okay with that? Great. Okay, now I'm going to show you the next slide. Those of you at the back, please take out the binoculars that have been issued to you. Okay, because the number is very small. I'm sorry, I can't make it any bigger because it's a spreadsheet and I have to show you the full slide, but just follow me, okay? Okay, it looks like this. Can you all see from behind? Cannot see. Okay, I'll try and explain this, okay? I mean, I wanted to break it into half, but it's not easy because if I don't show you the full spreadsheet, it is very, very hard. Okay, maybe, yeah, good idea. You take a picture, then you enlarge it. See whether you can see or not. Okay, I'll try and take you through, okay? So you follow me, okay? Now, David has about 1.6 million cash, 200,000 coming in from endowment, CPF Life, investment property. We calculated based on whatever he tells us he wants. We don't need to take all his money to fund. That's the good news. We don't need to take all his money to give him what he wants. This guy has got more than enough for his retirement. So we calculated that he actually needs, look up here on the top right corner, it says here 1.478 million. We only need to make use of 1.478 million of David's money. Okay? And this 1.478 million is split into 7 buckets until finally he kicked the bucket.
Okay, I'm not kidding, it's real. Okay, so 1.478 we split into 7. The first bucket is called income bucket. The second bucket is bucket 1, then followed by 2, 3, 4, 5, 6. And we break it into this proportion. Okay, now let me read it for you. The first one is 340,000, which accounts for 23% of the 1.478 million. The second is 329K, 329,000, which accounts for 22.3% of the 1.478. So on and so forth. The proportion is basically 23%, 22.3%, 12.4%, 14.8%, 7%, 6.4%, 14%. Everything adds up to 100% of the 1.478. Am I clear? Yes? Are we okay? What, turn around, suddenly half the auditorium gone. Okay, no. Okay, so now this is how it works. Income bucket below, no return, 0. Okay, and I'll explain why. Bucket 1 is 1.5% return. Basically, what this means is I'm investing 329,000 of bucket 1 into a 1.5% instrument. Nothing interesting at all. It's like your Singapore savings bond. It's like your money market fund. It's like your OCBC 360, you know, something like that, your bank account. Yeah? No risk, but very low return. The second bucket, I'm investing into something that gives about 3.5%. That is like a 85% allocation to bonds, 15% to stocks. Then bucket 3, investing into 5.5%. That is like 50% bonds, 50% stocks. Then your bucket 4, 5, 6, they are all investing into 6.5% return kind of portfolio, which is like a 85% in stocks, 15% in bonds kind of portfolio. Okay so far? Okay so far? People? Yes, sir? Okay, follow me, okay? Now, your income bucket has got nothing. Why? Because the money here, 340,000, is not invested. The 340,000 here is used to buy an annuity, insurance annuity. So there's no return indication there. Your income bucket, think of it like a bank account. It is meant to collect income. What income is coming in? Number 1, the annuity that you buy, the income is coming in. Number 2, David has got a 2,000 per month rental income that is also coming in. Plus, CPF Life at age 65 will also pay to this account. Plus, if he has got children, they will give him allowance every month, will also go into that account. Yeah? Retirees, please consider children as income. If not, have them for what, right? Yeah? So all that will go into this income bucket. Okay, now, this is the most complex and fun part. And once we are done with this, okay? This, I think, is my last slide, you know, then after that we're almost there already. Okay, now, so if you look at the income bucket, this is what is going to happen. Now tell me, what did David say about his retirement? In the first 5 years, how much does he want per month? 10,000. What, 5 years, 10,000? That means every year, 120,000, right? So if you look at the income bucket in the first year will pay out about 40,000. The remaining 80,000 that he needs, yeah, because every year, or rather the first 5 years, every year he needs 120K. Yes? So this income bucket will pay about 40,000, which comes from the equity, from the annuities, which comes from his rental income as well. The remaining 80,000, he will start to withdraw from bucket 1. So the minute this 329,000 is invested at 1.5%, that very minute the withdrawal starts. So in the first year after withdrawing, 329,178 will become 251,292. The withdrawal continue. At the end of second year, it will be 169,290. It's reducing because every year we are withdrawing down about 80,000. Then on the third year, it is down to 83,013. And then on the fourth year, actually it's supposed to be 0, right? Yes? Because it's supposed to withdraw another 80,000 to make it 120,000. 80,000 plus 40 is 120,000, right? But instead, it went up to 93,799. Can see? Why like that? Because notice the year, this is 2016. The maturity of the endowment came in already. So it went up by about 100,000. Okay, and then at the end of the 5th year, bucket 1 now is going up. 0. Bucket 1 finished liao. No more money in bucket 1. Clear so far? Income bucket always have money lah, because that is your annuity plus your rental income. But bucket 2 by now would have been invested for 5 years, right? So you will see 183,936 grow at 3.5%. Okay, by the time at the end of the 5th year, it would be 218,459. Now, bucket 1 0 right now. What I will do is I will take 218,459 and put it into the bucket 1 account that grows 1.5. Basically, I take the money, I transfer it into bucket 1 investment to get 1.5%. And I clear. Well, now getting softer and softer. Pretty clear. Not clear, man. I very, very slow. Not clear? Okay. Basically, this is what I mean. Let me try again. Income bucket is always paying. Every year, I need 120,000. That's me, David, for 5 years, right? Out of this 120,000, 40,000 come from the annuity. You'll pay me 40,000. I'm still short of 80,000, right? The 80,000, I'm withdrawing from bucket 1. Every year from bucket 1, I will withdraw 80,000. Plus my annuity from income bucket, 120,000. That's what I need, right? So at the end of 5 years, if I keep on withdrawing about 80,000, bucket 1 would be 0, finish. I keep withdrawing 0 already. But bucket 2 would have grown for 5 years, from 183 become 218 already. Now my bucket 1, no money already I need to fund bucket 1. So I take money from bucket 2 and I put it into bucket 1. Clear? Yeah. Why must I put it to bucket 1? Because this is money that I need for the next 5 years. Therefore, I cannot take risk. I better put into something that has no risk, which is 1.5%. So I transfer. 3.5%, although very low risk in bucket 2, 3.5% is still risky. So now I will transfer 218 to bucket 1. Now follow me. Okay, but this number is here, but they are actually in bucket 1. Okay, the grey shaded one actually is in bucket 1. So I start withdrawing about 80,000 again. I need to withdraw about 80,000 every year, thereabout. So I withdraw, it become 151, then become 92, then it's supposed to be 0, but went up to 132 again. Why? Because now 2020, the next endowment came in already. So now it's back to 132,68, 0. End of the 10th year, bucket 2 also habis, finish. Income bucket will always be there because it is an annuity, rental income, plus by age 65 years old, what pays out already? CPF life pay out already. Income bucket now even more money liao. Okay, what that means is that I will need to withdraw lesser from the bucket already. Okay, now by then, bucket 3 would have grown for 15 years already, or rather 10 years already. So 219 will now become 374891. I will now transfer 374891 again to bucket 1. And the withdrawal continue. And bucket 3 by the end of 15 years also going out. Understand? The story continues. Bucket 4 would have grown 20 years. I will transfer to bucket 1. After that, 0. But bucket 5 would have grown for 25 years or 20 years. Then I will transfer to bucket 1, withdraw 0. At the end of 25 years, my bucket 1, 2, 3, 4, 5, finish. 0. David is now 83 years old. If he is an obedient client, he's supposed to die. I mean, that's the plan. And if he doesn't die, is it his fault or my fault? His fault, right? Because that's the plan. So if he dies at age 83, bucket 1, 2, 3, 4, 5, no money. Bucket 1, income bucket, still have money because it's an annuity. But you look at bucket 6, it has been invested for 25 years. Okay? And if I do back testing of how the stock market has been performing the last 25 years, I just buy index, I don't do anything, I don't go and trade in, trade out, trade in, trade out, trade out. You will see it's positive over the last 25 years. I've done it for US market, European market, Hong Kong market, emerging market, no, not emerging, Hong Kong market, the German market, all the major markets, I've done a check on the last 25 years. If you do nothing, you just buy the index, you would have gotten thereabout 6% return, thereabout. Okay, so you would have gotten about $1 million. Okay, of course, my assumptions can go wrong, and if my assumptions go wrong, then we have to do some financial planning and all that. But let's assume that the assumptions play out. David now leaves behind $1 million for his children. So if at 83 David dies, who celebrates? Children, yes. Yeah, but if David survived, then the children sad. Okay, and David will now need more money to survive because bucket 1 to 5 finished already, right? But no problem, at age 83, he still got income bucket and still paying, and his 1 million, he can still live on. More than enough, 83, how much can you spend? Right? And finally, one day, David will die. He cannot be eternal, he will die, right? Then whatever that's left behind of this bucket, he pass it on to the children. Okay, so far? I know it's complex, it is, I understand, especially you're sitting at the back and you cannot see this thing. I'm sorry, but you realize why I cannot try and cut it, because then I cannot talk about the market, right? Now, but you realize that there are various instruments at play here. CPF Life is at play, investment property you have is at play, your insurance endowment is at play, but a large part of it is all investment, and this guy is in retirement, but the investment is split over 25 years. With the first 5 years of money that he needs always in low risk, because if the market collapses, at least the next 5 years he's fine. Okay? So sometimes it's very difficult for me to answer this question. Oftentimes, at a panel or in the media, they will always ask, is it true that as one age you should allocate less money in equities? And the answer is, standard answer is yes lah. Right? I mean, that's standard answer, right? But if you look at this example, is it yes? It's no. This guy is 70, 80 years old, he still has a lot in stocks, So it's not as simple. And now you understand why the more money you have, the more complex it is. So if you look at this and you say, hey, I don't have so much money, then the previous plan will work for you because it's a lot more straightforward. Okay? I believe this is my last slide, but I want to say this, okay? I'm going to just close this part and then I'm going to transit to the closing remark with something that I want to share with all of us. The topic given to me is investment strategies before and during retirement. Before retirement is really simple. Comparatively speaking, I hope by now you see that when you are accumulating for retirement, actually very easy. You just need to know your need, ability, willingness to take risks. Find a portfolio to invest towards. It could be 5% return a year, 6% return a year, as long as you stay there. Keep investing. Invest regularly. Good times, bad times, you just put in money regularly. Don't put everything in, put regularly. You will do fine. But when you are in retirement, it is not so complicated, or it's not so simple, it's a lot more complicated. Your monies really have to be spread across different instruments, and you've got to phase it out. Because during retirement, or rather when you are accumulating towards retirement, your focus is on ROI, return on investment. But when you are in retirement, your focus is now shifted to ROI also. But it means now reliability of income. In retirement, you are not too worried about how high a return. You are more worried about every month I must have the income, reliability of income. But when you are accumulating, it's about can I get 6% or not? Return on investment. Different phase of life, different style. Okay, so far? Yes or no? Yes. Okay, great. Okay, now, I'm done with my formal presentation. Check time, 4:50, great, I'm on time. Now, I have been asked, and this is indeed my honor, because usually Mr. David Gerald will come here and do the closing remarks. But today he has decided to arrow me to do the closing remarks. Okay, but it's a privilege to do a closing remark because you've been here for the whole day, and the theme for today is investing in during different stage of life. So I thought a little bit about this, and I asked myself, what is it that I want to tell you that you don't already know since you've been here the whole day? and decided that I will share with you my story. Some of you have heard this story before, but I'm sure most of you haven't because I've never shared this outside of my clients. I've been born in a pretty poor family. My father was a bus driver, and I'm a Toa Payoh boy. This is my town. Okay, I spent all my childhood here, and for those of us who are more senior, you will know, I used to stay in block 102 Toa Payoh, which is a HDB studio apartment. You know what's that? That's a one-room flat, a rental apartment. There are no bedrooms. The only 2 rooms is toilet and bathroom. Daytime, the mattress go to the side of the wall. Nighttime, the mattress come down. My parents have 4 kids. You know, in the middle of the night, if you go to the toilet, you basically walk on top of each other. That is where I grew up. And then subsequently, when my father had a little bit more money, we moved to block 194 Kim Kiat Avenue. It's a 3-room flat. He bought it for $9,000. It's a very good place because every morning at 6 o'clock, you don't need alarm clock. The temple will go gong, gong, and you wake up. Free alarm clock. But that was how I grew up. And so money was very scarce because my father doesn't earn a lot of money, and money was very important. And then subsequently, I grew up. Before I came into this financial services industry, I spent a short time in the healthcare industry, very short, 1.5 years. And prior to that, I actually spent 6.5 years in the army. I was a regular army officer, and one of the many reasons why I sound, besides the fact that I love the army and I love to serve the army. Most guys think I'm crazy, but I really love to serve the army. I love it so much that until now, although I finished my liability, I'm still serving because I volunteered. But I joined the army, one of the reasons was because I needed to earn my own money to study for an education. I got my degree, did a postgrad, and then finally when I wanted to go into financial services, I couldn't because it was 1997 Asian financial crisis. Nobody was hiring. Nobody were hiring. But finally, when the crisis blew over after 1 over years, I joined the financial services industry in 1997, end 97, early 98. The first place I joined was an insurance company because back then there were no such thing as financial advisory. You either join the bank, you join the insurance company, or you join as a stockbroker. So I spent 3 years with the insurance company. I made a lot of money at the age of 27 years old because my focus was making a lot of money, because if you come from a very poor family, you don't want to be poor anymore. And you want to make a lot of money, and I did make a lot of money. At age 31 years old, at the peak of my career, I was making about 200,000 a year. That was 2001. That's a lot of money, you know. It's still a lot of money today, but it's a lot of money even more then. But it was then that I decided to leave the insurance company. And one of the many reasons why I left the insurance company was because I just didn't like how the things were done. And so I left. And those of you who have read my articles, you know what I don't like. I basically don't like selling whole life plans. I strongly advocate term life, you know, and all that. And so I decided to come and start a company, which is the company that, you know, you see behind, it's Provident. But that was 2001, September 11 happened. Cut the whole long story short, couldn't start business until 2003, and I decided to build the business then. In those 10 years, 15 years of my life, when I started building my company, I was so focused in wanting to do well, make a lot of money, fulfill a dream, of course to prove to other people that yeah, I can do it, and I worked very, very hard. I worked more than 14 hours a day. I worked really, really very hard. My focus was always to make that money that I wanted to make. But as a result of me working so hard, I really neglected my family. And the turning point came one day when my daughter, my kids are all grown up today, but you know, when she was young, you know, our kids, they go for swimming course and all that. They have the survival, bronze, silver and all that. And my daughter was doing her bronze test. And one of the things she had to do was to take out her pajamas, beat it into a float, you know, and all that. And despite all the training she received, she couldn't do it that test day. And she was drowning, and she was crying, you know. And I went up there, and then I was telling her, come, it's okay, no problem, you know, come up, Papa will carry you out. To my horror, she doesn't want me. Because I have been absent in her life during that time, and she doesn't want me. And it was only until my wife went forward that she went to my wife. But that was a turning point for me because it was very painful. I mean, as parents, you know, your kids don't want you even at the brink of death. But that was me. That was the father that, you know, that I was that kind of father, and I was never there in their lives. But of course, that was many, many years ago. That was like maybe 7, 8 years ago. And ever since I turned around, I decided that I will never go back, wanting to go back to that same life again. I began a journey of asking myself, actually, what really will make me happy and what really do I want? I didn't go and attend any Anthony Robbins course, run across fire. I didn't do that. Yeah. I mean, my daughter doesn't want me. It's a good experience enough for me to tell me that something is wrong with my life. And so, at that point in time, I journeyed and I told myself that, I want to, this is what I want to leave behind. This is the legacy I want to leave behind for my children. If I die, this is what I want my children to remember me as. This is what I want my friends and my colleagues to remember me as. And when I meet God, I can be accountable to Him. And that's what I decided. And as a result of that, I came up with a whole list of activities that I want to do. Chief of it was that I wanted to take my family for holidays that I have been depriving them of, because I was a real workaholic. And one of the things I always remember my son when he was young, he said, "Pa, just before I go into the army, can you bring me to Manchester United and watch a live game?" Because Man U is his club. Mine is Leicester City. Only this year, Leicester City. For those ladies who doesn't understand this, it's okay. So anyway, one of the things that I wanted to do was that, I wanted to make sure that I can bring my family for a longer holiday. And so 5-6 years ago, I made a very major decision. I sold down my private property. From 2 cars, it became 1 small little Japanese car. We moved back to the public housing. Do I still miss my condo? Yes, I do. Do I still miss driving my own car? Yes, I do, because the car I pay, my wife drives. Every day I take public transport to work. Do I miss it sometimes? Yes, I do. But when I remind myself what I did that, very quickly I'm okay to live the life that I'm living right now. What am I sharing all this with all of you? Because we are talking about investing in different stages of life. But I want to speak to those people who are accumulating towards your retirement. I know this is a financial seminar, but life is beyond money, isn't it? And before you decide how much money you want to put into your investment, and before you decide what is your need for return, first make a life decision. Ask yourself what really will make you happy. What is the legacy you want to leave behind? And the things that you need to do in order to leave that legacy. And some of these things, you need money to fund it. Like me, I need to bring my family every year for a long holiday. It's an investment. In 2009, I brought my family to Old Trafford to watch the Man U game. Okay, it's an expensive game. And then whatever you leave behind, then you decide how you want to invest towards that retirement. Think about the kind of life you want to live, the purpose that you want to live for. A lot of us when we are young, we think of making a lot of money, investing for maximum return, and then finally, when I retire, then I go and achieve that dream. We don't have a contract with God, man. You can die today. For those of us who are retiring, you now have the money and you deserve to rest. But retirement is not just about money. Retirement is also not just about health. Retirement is also about the purpose that I want to live for in the remaining 20 to 30 years of my life. Something that when I'm gone, I want to leave behind. And many of us have dreams. It's just that as we are growing up, we are busy with our lives. We forget about our dreams. And now is your chance for those of us who are retiring. With whatever money that you're retiring for, don't just leave behind a huge chunk for our children, unless I'm your children. Think about how you want to spend this money to live that dream and live that purpose. And then remaining, you invest. My point is, first make a life decision before you make a financial decision. Don't make a financial decision first, then make a life decision. It's going to be disastrous. Our financial decision must follow our life decision, not the other way around. Money is not a goal. In my industry, money is a goal. If you sit down with me as a client, we always talk your financial goal. But in truth, money is not a goal. Money is an enabler. It is a tool. So look at money that way. One last thing. I want to talk about what's going to happen over the next 20, 30 years. The study has just came out from consultancy, this particular consulting firm called McKinsey. It's a very big consulting firm. And basically in that paper, you can go and Google it, it's out there on the website. The premise is this: if you think that the last 20 years investment has been very, very tough, especially we remember Asian financial crisis, dot-com bubble, the great financial crisis of 2008, and you find that investment is very tough, returns are bad, then we are very wrong. Because actually the last 20 years have been the best years for investing. The returns have been very good, despite volatility. The next 20 to 30 years is going to be very tough. You expect returns to drop. You expect huge volatility. That's because today we are seeing geopolitical risks that we have not seen in the past. Today, foreign currency affects investments. In the past, foreign currency is an investment tool. Today, when central bank makes decision, it affects decision, it affects investment return big time. So the next 20 to 30 years, you will be very happy if you can get 6% per year consistent. That is the kind of return we are looking at, no longer the 9%. Over the last 20 years, we have China opening up. As a result, the stock market went up. But China is today very developed. You expect GDP to drop, it is dropping. It is going to be very hard to expect that kind of return over the last 20 years. Again, what is my point? My point is whether you are investing towards retirement or whether you are investing in retirement, my suggestion is expect much lower return, rather save more. Okay? And if McKinsey is wrong, and I hope they are wrong, we get more than what we ask for. But if they are right, at least we can slow down. That's the message that I want to send to everyone. Save more. There are many instruments today that are really risky. I wouldn't even touch it. I'm financially trained. I understand. I wouldn't touch it. I would rather invest in something simple. I'd rather save more. Go for a prudent approach. Please do not overtake your loans. Okay? Especially over the next 5 years. Don't get into this kind of trouble. Taking loans beyond your means, investing into risky instrument. Okay? If you do just that, you will be fine. The last thing that I have to say before you go, that I've been asked to say, and I would like to say is this. This one is advertisement from SIAS. I've been speaking for this kind of program for the last, I don't know how many years, maybe close to a decade. Okay? It is my calling. I love to speak to all of you despite the fact that, you make me work, on a Saturday afternoon and all that, but I love to do this because it's my way of giving back. And you believe in this initiative, and especially all these financial literacy programs and all that, especially for the young people. They are coming up, learning how to invest and all that. I ask you to also do your part. Each one of you, when you walk out, please donate $1,000. Okay, there is a way for them to invest. Donate, right? Okay, I don't know. Okay, because I don't know about this. Okay, but if you can, okay, we ask you to donate to this good cause. SIAS is a non-profit organization. Okay, their monies they don't make a profit doing this. People like us, they don't pay us like $10,000 to speak to you. They only pay us $5,000 for 45 minutes. It's not free, no, it's free. So I ask you if you can, okay? Donate for a good cause, and hopefully we can do more of this kind of talks for the people. All right, I think I've spoken enough. Thank you for joining us this whole day. Okay? Have a good weekend. Thank you.